Welcome. We're jumping right into public company reporting. This is a huge topic for the BAR exam, where it's not just about knowing the numbers, but really understanding the story behind them.
Okay, let's get started. Before we look at a single form or rule, you have to get this one thing down. The number one rule for the bar exam is to think like an investor. See, the exam isn't just going to test if you memorized filing deadlines. It's designed to test if you can look at a company's report and make a judgment call. Every disclosure, every footnote, it all exists to help someone decide whether to buy, sell, or hold. That's the only lens that matters.
So here's our game plan. We'll start big picture with the SEC framework, then drill down into the key filings you absolutely have to know. After that, we'll get into the good stuff, management story in the MD&A, special disclosures, and then we'll put it all together with a case study before wrapping up with the right mindset for exam day.
First off, why do we even have all this reporting? Well, the whole point of the SEC's framework is to create a level playing field. It's all about making sure that every single investor, whether you're a giant hedge fund or just a regular person with a retirement account, gets the same important information at the exact same time. It's about fairness and transparency, so everyone can make smart decisions.
Okay, so let's get into the actual documents that make this all happen. You got to know these inside and out for the exam, what they are, and when they're due. These filings are really the main way a public company talks to the outside world. This chart lays it out perfectly. You've got three main players. The Form 10-K, that's the big one. It's the annual report, a super deep dive into the business, and its financials are fully audited. Then there's the 10-Q. Think of this as the quarterly pulse check. It's not as detailed, and the financials are just reviewed, not fully audited, but it keeps investors up to date. And finally, the Form 8-K. This is like the breaking news alert. If something major happens, like a merger, a bankruptcy, or a CEO suddenly quits, the company has to file an 8-K right away. And timing is everything. For the annual 10-K, the deadline actually depends on how big the company is. The market wants info faster from the bigger companies. So a large accelerated filer, we're talking a public float over $700 million, they only get 60 days. Accelerated filers get 75, and smaller companies get a full 90 days. It just makes sense, right? Bigger companies have more resources and more impact on the market. All right, now we're getting to what I think is the most important part for the bar exam, learning to read between the lines of what management is telling you. This is where you go from just knowing the rules to being a real analyst. The numbers only get you so far. The narrative is where you find the real story. And this is the critical distinction you have to understand. The financial statements, the income statement, balance sheet, statement of cash flows, they're the facts. They tell you exactly what happened. But the management's discussion and analysis, the MD&A, that's where management gets to explain why it happened. It's their side of the story, and it's where your analysis really begins. So when you're reading the MD&A, you're on a hunt for the why. You'll see results of operations. Don't just see that sales went up. Find out why. Was it a hot new product, or did they just raise prices? Then you've got liquidity and capital resources. Can this company pay its bills? Where's the money coming from to grow the business? And maybe most importantly, this is where management has to talk about the future, the risks, the trends they see coming. That's pure gold for an investor.
Now, you're going to see stuff like this all the time, especially in press releases. Adjusted EBITDA. These are what we call non-GAAP measures. Basically, they're custom-made metrics that don't follow the official rules of generally accepted accounting principles.
And that is the million-dollar question you have to ask yourself every single time. What exactly is being adjusted out? Management is taking a standard number and tweaking it. They're adding some things back, taking other things out, all because they think it gives a better picture of the company. The key is figuring out what they decided to ignore. And here's the risk. These non-GAAP numbers can be super misleading. Companies often use them to make things look better than they are by excluding very real expenses like restructuring costs or stock-based pay. Because of this, the SEC has a super important rule. If you show a non-GAAP number, you must show a reconciliation that ties it back to the closest GAAP number. That reconciliation is everything. It's the map that shows you exactly what they took out. Okay, moving on. Beyond the big filings, there are a few special disclosures that give us some really important context. And you can bet these are favorites on the exam because they show whether you can see the deeper story. Segment reporting is incredibly powerful. It uses what's called the management approach, which basically means the company has to show you its financial results broken down in the exact same way the top boss, the chief operating decision maker, or CODM, looks at it. So you get to see the company through the CEO's eyes.
It tells you how they actually run the business and which parts are making money versus which aren't.
Then we have subsequent events. These are things that happen after the year-end date on the balance sheet, but before the report is actually released. There are two types. Type 1 gives you new info about something that already existed at your end. Say, a big customer goes bankrupt in January, but they were already in bad shape in December. You have to go back and adjust your December financials. A Type 2 event is something new that happens after year-end, like a factory burning down in February. You don't change the December numbers, but you definitely have to disclose it in the footnotes.
Now this is a biggie. The going concern disclosure. Management has to look ahead 1 year and ask themselves, is there substantial doubt that we'll still be in business? And if the answer is yes, they have to come clean about it and explain their plan to fix things. For an investor, seeing a going concern disclosure is a massive red flag. It's management saying, hey, we might not make it.
All right, let's do a quick case study to pull all of this together. This is exactly how your brain needs to work on the bar exam, connecting the dots from the raw numbers to the actual story. Meet Novatech Solutions. Here are their key numbers for the past 2 years. Just take a second and look at the trends. What do you see? So step 1 is just the basic observation. What are the numbers telling us? Well, revenue is up 10%. Not bad, right? But wait, operating income is down 25%, and cash flow from operations fell off a cliff, down 44%. Houston, we have a problem. Okay, step 2. We go straight to the MD&A to figure out why. This pattern right here, sales up, profit down, is a classic sign of what we call margin compression. It means that for every dollar of sales they're making, their costs are going up even faster. Something is eating away at their profitability. Now, for step 3, we look at the cash. That 44% drop in cash flow is seriously alarming. You know the saying, profit is an opinion, cash is a fact. This huge drop tells us there could be a liquidity crisis brewing. Maybe they're selling a lot, but they're not collecting the cash from their customers, or maybe they have a warehouse full of stuff nobody wants. Either way, it's a huge problem. So, step 4. What does this all mean for an investor? Well, that 10% revenue growth headline looks pretty hollow now, doesn't it? This is unprofitable growth. The company is getting bigger, but it's also getting weaker financially. This is not a sustainable model. But then, you see this in their press release. They're not talking about their GAAP operating income of $60,000. No, they're highlighting their adjusted EBITDA of $100,000. Looks a lot better, doesn't it? And that's your cue for step 5, put on your skeptic's hat. Your immediate thought should be, okay, how did you get from $60K in real profit to $100K in adjusted profit? They had to have added back $40,000 in expenses. Your job is to go find that reconciliation and see exactly what they're trying to convince you to ignore. It's probably the very thing that's causing all these problems. And just a quick note, we used nice, clean numbers here to make a point. On the exam, the numbers will be messier, but the logic you use to analyze them is exactly the same. So let's wrap this all up into a framework you can use on any question. This all rests on a foundation of strong internal controls, which is a big deal under Sarbanes-Oxley. Management has to build them, and auditors have to check them. It's what gives us any trust in the numbers in the first place. Here it is, your 5-step blueprint for exam day. 1. Identify what kind of disclosure you're looking at. 2. Figure out what changed or what the key piece of information is. 3. Link it to the financial statements. How does it impact the numbers? 4. Use the context, especially the MD&A, to figure out why. And 5. The most important step. Put on that investor hat and decide what this means for the company's future. See, public company reporting is so much more than rules and deadlines. It's a story. If you can master this interpretive mindset and learn to read the story hiding between the lines, you are going to be in fantastic shape to crush the BAR exam.